and welcome, StockCharts users, to this multi-part series from GoNoGo Charts that's designed to be educational in nature and help you understand technical analysis as well as the use of GoNoGo Charts. My name is Tyler Wood. I'm a CMT charter holder, and with me today, as always, is Alex Cole, the chief of charts and creator of these powerful tools. How are you doing today, my friend?
I'm doing well. Excited to be doing this educational material.
Absolutely. So we really appreciate you guys joining us for this multi-part series. And one of the concepts that we're going to drill home session after session is the idea of having a rules-based process, a discipline, if you will, that's consistent and repeatable, no matter what is happening in the markets. So just stop and think for a second if perhaps your trading was a little different. Perhaps you felt a little differently in 2022 than you did in the year prior, or maybe even this year, you're trading a little differently than you did last year. We know that the outcomes of trades are going to look different depending on a trending or mean reverting marketplace, but we want our rules and our checklist to be the exact same no matter what the market dynamics are. So to help illustrate that point, Alex, why don't you talk to us a little bit about what's going on with your teenage son these days?
Yeah, absolutely. It's a busy time of year. At the end of the school year, I've got a daughter graduating from middle school, and my son, as you just mentioned, starting to drive, going to be a junior this upcoming year. So it's, of course, super important for anybody learning to drive. And as a parent, you worry about your kids, of course, getting behind the wheel. So there's certain things that I would want him to do every single time he sits down in that seat. Fasten your seatbelt, keep your foot on the brake so you don't accidentally jump forward. Check your mirrors, of course, before you pull out into the road. Signal to warn any oncoming traffic of what you're going to do. And you do all of this before you then finally engage a gear and drive off. And if you can follow those steps, you know, you're stacking the odds in your favor that you're going to be a more responsible driver and you're not going to get into any unfortunate incidents. And the same can be true, of course, with our discipline of learning technical analysis. You want to have that process that allows you to make sensible decisions without taking on any unnecessary risk. And you can use any number of the tools at our disposal. You could be using Dow theory, trend lines, moving averages, pattern analysis, support and resistance concepts, or indicators, as we'll see, to help us identify trends and to hopefully identify them early enough so that we can then take advantage of them. So what are we talking about? If we can identify trends in prices, then we can arguably profit on the majority of that move. Now, when I say arguably, what I meant to say was that it's arguably the most important skill that we can learn as a technical analyst. Because if we can identify those trends in price action, we can trade in the direction of the trend and we can put the odds in our favor of making the correct decision. We like to say that this is a simple concept, but of course not easy to execute.
Now, of course, that process could begin with simple visual identification of the trend. Can we see price action moving, for say, from the lower left to the upper right of the chart that we're looking at? Well, that's great. It's very subjective in nature. And of course, it only works in hindsight. But what you're doing when you just eyeball the chart is noting a series of higher highs and higher lows, which is the definition of an uptrend, or lower highs and lower lows in a downtrend. Now, if we want to be more objective and we want to participate in those trends earlier, we might use a tool like Donchian channels or price channels to help us identify trend entry points. Now, this is simply plotting a line above and below price action that represents the current high and low over a defined look-back period. And tracking those new highs and lows over that set period is going to show us when we are establishing a series of new highs in a trend. For those of you who are familiar with the turtle traders, this wonderful story of Richard Dennis, who wanted to train and teach folks with no financial market experience. And we had the great fortune of spending some time with our good friend Jerry Parker at the CMT symposium just a couple months ago. And what was astonishing was that a lot of the methods and tools that he learned from Richard Dennis back in the day are still an active part of his discipline as a trend following investor today. So I highly encourage you all to check out some readings about the turtle traders, read that book. And you could use Donchian channels to be a little more objective in identifying the start of a new trend. Now, of course, Alex, why don't we talk about perhaps the most widely used tool that might not even characterize technical analysts?
Absolutely. I mean, we've seen so many charts, Tyler, in our time with moving average upon moving average on them. You know, everybody has the 50 and the 200 on there. And these are people that wouldn't even consider themselves technical analysts, but it's such powerful information. And if you think about it, it makes a lot of sense. Looking at where price is relative to a moving average of its historical prices is going to tell us whether or not we're in a bullish environment or a bearish environment. If price is trading above an average of its prices, then price right now is moving higher than it did in the past. And that is inherently bullish, of course.
Now, of course, with simple moving averages, everybody's looking at them, but there is still a little bit of interpretation left to the analyst or the trader or the PM. So if we see prices above a moving average, that's bullish. How about prices above an upward sloping moving average? Does that give you more conviction in the trade? And more often than not, folks who find power in a single simple moving average might suggest maybe 3 or 4 or 5 would be even more helpful, right? So they can use a series of moving averages to not just identify that relationship for price action to its historical mean, but also the relationship between shorter and longer period moving averages. So on this chart, we could see a 20 period moving above a 50 period, and that cross above or below is going to give us some trade signal information. But again, there's a little bit of interpretation left to the analyst. And of course, this is all dependent on the parameters you choose for your multiple moving averages. How frequently do you want to trade? Are you worried about whipsaws? Do you have the conviction in each of those trades to follow those rules? So Alex, let's keep going and talk about some of the other powerful tools that folks could find on their StockCharts platform.
So another one is Bollinger Bands. Of course, we've known John Bollinger for a long time, and we saw him as well at the recent CMT symposium. But we've been looking at Bollinger Bands in our industry to identify important moments. If you think back to your understanding of standard deviations, perhaps from math class back in the day, the good old days, we know that in a normally distributed data set, at least about 95% of all of the data should be contained within 2 standard deviations around a mean. Now, financial data is not normally distributed, so it might be slightly different, but the vast majority of financial data is going to trade within 2 standard deviations of a mean. So that tells us that when price moves outside to the limits of those bands, that's important information. And there's a couple of different ways to read these bands, but for trend identification, when those bands are narrow, then we look to trade in the direction of the break. So if the bands are narrow and price is trading outside or the upper bound of a Bollinger Band, we're going to look at that as perhaps the beginnings of a new trend.
So we can look at simple annotations, trend lines to identify lower highs and lower lows. We could apply Donchian channels and some moving averages. We could look at Bollinger Bands. But of course, there are a lot of other pieces of information that are going to help us confirm or perhaps diverge from what we're seeing in price action. 130 years ago, the great Charles H. Dow wrote to us about the importance of volume as a confirmatory indicator to market participation. So when we're seeing new price highs, we also want to see that supported by market participants. Higher volume on those upward price moves confirms the trend that we're seeing in price action. Meanwhile, low volume or heavy volume to the downside is going to let us know that that trend may be exhausted or coming to an end. So we can add a volume histogram in the lower part of our chart to give us yet another important piece of information for establishing trend direction and the strength and durability of those trends. Alex, let's do one more. Let's look at Gerald Appel's moving average convergence divergence.
Yeah, of course, another popular indicator. And you can see at this point, we are really lining up the pins, so to speak, before we can knock down our decision. And you can see that they're all telling us something. And MACD is another one that's so vitally important. We can look at the crossover between MACD and its signal line. Of course, MACD is looking at the difference between 2 exponential moving averages. And when MACD itself goes above the 0 line, also very important information, because that's telling us that the shorter average of prices is moving higher than the longer average of prices. Again, an inherently bullish situation. So perhaps we're looking at MACD now in that lower panel, and somewhere there in the middle of the chart, we're saying, okay, we've got MACD and its signal moving above the 0 line. We've got a new high in Donchian channels. We can walk through the list. We can see price is above its moving average. We also can see that the 20 crosses above the 50 there somewhere within that blue oval. And we can also take a look at Bollinger Bands, where we see that the Bollinger Bands are narrowing as price gets to the top of those bands. Take a look at volume to make sure that volume is consistent, hasn't dropped off too much as we're seeing what we're seeing in price action. And somewhere in here, we feel fairly confident that we're seeing the beginnings of a new trend. But where exactly and whether or not we can be sure based on the number of indicators firing at different points, that remains very subjective. And you can see that this is a simple process at this point, Tyler. So many of the people we talk to have far more things on their chart than this.
Absolutely. For anybody who has been through the CMT program, you know that with each chapter you read, a new indicator you discover, that next piece of information is so important to you to get on your chart. And what Alex is talking about is that subjective interpretation. There is a month worth of market action happening inside that blue oval. And where exactly in this checklist of tools do we feel confident enough? Do we have enough confirmation? Do we have all of our signals telling us that the new trend has started? Or do we make a decision subjectively based on certain indicators over others? We start to introduce a lot of behavioral pitfalls when we have a chart like this. And as Alex said, this is not even a particularly complex chart. We've all made charts like this or seen them on the trading floor, and it is a big problem for two reasons. One, many indicators are going to be redundant to one another and at times even contradictory. We talked about the subjective interpretation of exactly when is the trade entry signal in that last chart. But the other problem is we're starting to lose sight of price. And our most important indicator of all is price action itself. All of these other derivatives from volume and price information are helpful in confirming or diverging from what we're seeing in the price action. But let's not forget about the importance of more classical technical tools like important areas of support and resistance or even pattern analysis. So Alex, let's talk a little bit about the solution, the GoNoGo trend indicator.
For sure. We ended up with the GoNoGo trend to try to solve those problems, but of course, keeping the information that we found so valuable from all of our studies in technical analysis. And by working with all of the institutional clients we worked with over the years, we want that disciplined checklist. We want to use technical analysis to understand what we're seeing in the markets. And so we blend behind the scenes some of the foundational concepts of trend following, along with some statistical measures that are robust and tried and tested, into an indicator that color codes price based on the strength of its trend. And so what we're left with is just the price panel. Nothing to shrink price. We're just left with price in our main panel, but it is color coded to give us the technical understanding that we need. And if you look at the chart, it's coded with 5 different colors. There are 2 colors for our go trends or our bullish trends. There's the weak form aqua, and then the stronger form bright blue. The same for our bearish environment. We've got a weak pink color, and then the strong form bearish, where all of the criteria being met to the downside, is a stronger, darker purple. You might see on here a couple of amber bars as well. Now, the amber represents uncertainty or neutrality for us. This is suggesting that not enough criteria being met in either the go or the no-go conditions for the indicator to identify a trend. So it paints the bars amber. And we call these the go fish bars because we're both big fans of the works and life and times of Jesse Livermore. And he was famous for saying there's a time to go long, a time to go short, and a time to go fishing. Sometimes the market just doesn't give you what you need to make a decision either in the up direction or the down direction. So go fish.
Alex and I are so indebted to the men and women of Wall Street who have created, innovated, observed the first principles of the market and given us this incredible toolkit. So we want all of that information. but we want all of the heavy computation taken care of in the back end so that our data visualization remains crisp and clear. And one of the important things that you can do with a GoNoGo chart is to see areas of resistance, right, that once broken through become areas of support, that concept of polarity. And it's very easy to identify those critical price levels in a chart that is not clouded by analysis paralysis or indicator overload. And that is exactly what GoNoGo Trend is bringing to the table. Now, we're so proud of this work. We have learned so much from our institutional clients and the folks that we have worked with over the last few decades, and we want to give it away for free. So right in StockCharts, if you go to the ACP plugins, you can grab the GoNoGo Charts starter pack and apply GoNoGo Trend to your charts absolutely for free. You can use that indicator on any time frame, on any security, and all we ask for in exchange is just let us know how it's working. What securities do you trade? What time frame are you focused on? And has it changed your process, your investment decision-making process? So thanks so much for tuning in to this first installment of a multi-part series of educational videos from GoNoGo Charts here for StockCharts.com. Thanks so much for joining us, and we'll see you again next time. Until then, trade them well.